Pause for a moment. Do not adjust your screen, because what you're about to hear is not a forecast. It is a confirmation. Shanghai did not approach 87. It did not test it. It reached it. And when the world's largest physical silver market crosses that level, something quietly breaks elsewhere. This is not a story about price. It is a story about control. Why are buyers in Asia paying prices the West insisted were impossible? Why is panic buying no longer driven by retail emotion, but by institutions that cannot afford to be wrong? And most importantly, if Shanghai has already accepted 87 as reality, what does that mean for everyone still pricing silver far below it? Stay with this analysis, because by the end of this video, the question will no longer be whether the system is changing, but how late most people are realizing it. Welcome to Hidden Currency. If you're someone who has lived through multiple market cycles, if you have seen promises made quietly and broken even more quietly, then this channel was built for you. We do not chase headlines here. We trace pressure, incentives, and consequences. If that way of thinking still matters to you, subscribe, not for us, but so you do not miss signals that others only understand in hindsight. And tell us in the comments, from which country are you watching this unfold? Now, let's begin. The first signal did not come from New York. It did not come from London. It came quietly, decisively from Shanghai. When silver reached $87 on the Shanghai Gold Exchange, it was not treated as a shock inside Asia. It was treated as an adjustment, a recognition that the old reference points no longer applied. To casual observers, it looked like a strong rally. To those who study structure rather than headlines, it looked like a warning. Markets do not move because of emotion. They move because of necessity. And the move in Shanghai revealed a necessity the Western pricing system could no longer contain. In Asia, silver is not just a trading vehicle. It is a working material. It is used, stored, moved, and consumed. Price reflects availability. When price rises sharply, it is usually because supply is tightening in the real world. At $87, the market was not celebrating upside. It was rationing scarcity. This distinction is critical. Western markets rely heavily on derivatives. Futures contracts and paper instruments dominate daily volume. These tools create liquidity without moving metal. They work as long as confidence holds and delivery is rare. Shanghai operates under different rules. Physical settlement matters. Inventory levels matter. Premiums matter. When buyers appear in force, price adjusts upward because metal must be allocated to those who need it most. The move to 87 was not speculative optimism. It was a signal that replacement had become uncertain. This is where panic buying begins. Not with fear, but with realization. Industrial buyers do not chase charts. They protect operations. When procurement managers see prices rising alongside shrinking availability, they do not wait for confirmation. They secure supply before the next adjustment. Each buyer that acts early forces the next buyer to pay more. Each transaction confirms the shortage. Price rises not because buyers expect profit, but because they fear disruption. That is why the Shanghai price matters. It reflects urgency, not sentiment. As Shanghai moved higher, a gap opened between Asia and the West. This gap created strain. Arbitrage systems activated. Institutions recalculated replacement costs. The difference was no longer theoretical. A global commodity cannot trade at two prices indefinitely. Either one market is wrong, or the system connecting them is under stress. For years, the assumption was that Eastern prices would adjust downward. That assumption depended on abundant supply. That abundance no longer exists. Silver supply is constrained by geology, declining ore grades, and byproduct mining. It cannot be increased quickly. Demand, driven by energy, technology, and defense, does not fall easily when prices rise. This imbalance is the core issue. Shanghai acknowledged it. Western markets lagged behind. Banks that normally provide liquidity hesitated. Selling silver cheaply while Asia paid more meant transferring value away from themselves. The rational response was withdrawal. When sellers step back and buyers remain, price does not climb gradually. It jumps. This was not enthusiasm driving the market. It was absence. For business leaders and entrepreneurs, this moment carries a broader lesson. Pricing systems fail when they detach from physical reality. Models based on averages collapse when replacement costs become unpredictable. Shanghai did not announce a new era. It revealed one. And once reality is revealed, the rest of the system must adapt, whether it is ready or not. What followed the Shanghai move was not confusion. What followed the Shanghai move was not confusion. It was calculation. Once silver settled above 87 in the physical markets of Asia, a chain reaction began across institutions that rarely act publicly, but always act early. These were not traders chasing momentum. They were systems responding to imbalance. Every global market runs on a simple assumption. Supply can be sourced when needed. When that assumption weakens, behavior changes immediately. Part 2 of this story is not about price levels. It is about the mechanics that forced acceleration. The first mechanism was arbitrage. Large institutions continuously scanned global markets for price discrepancies. When silver traded significantly higher in Shanghai than in Western exchanges, models activated automatically. These systems do not debate narratives. They respond to spreads. If an asset can be acquired cheaply in one region and sold higher in another, capital flows instantly. But silver is not software. It is heavy, regulated, and slow to move. As arbitrage demand surged, it encountered friction. Shipping timelines, refining capacity, export controls, and existing contractual obligations all limited how fast physical metal could travel. The spread did not close smoothly. It widened under pressure. This created a feedback loop. Each attempt to close the gap consumed more available inventory, which pushed prices higher in both regions. The process fed on itself. The second mechanism was withdrawal of liquidity. It was calculation. Once silver settled above 87 in the physical markets of Asia, a chain reaction began across institutions that rarely act publicly but always act early. These were not traders chasing momentum. They were systems responding to imbalance. Every global market runs on a simple assumption. Supply can be sourced when needed. When that assumption weakens, behavior changes immediately. Part 2 of this story is not about price levels. It is about the mechanics that forced acceleration. The first mechanism was arbitrage. Large institutions continuously scanned global markets for price discrepancies. When silver traded significantly higher in Shanghai than in Western exchanges, models activated automatically. These systems do not debate narratives. They respond to spreads. If an asset can be acquired cheaply in one region and sold higher in another, capital flows instantly. But silver is not software. It is heavy, regulated, and slow to move. As arbitrage demand surged, it encountered friction. Shipping timelines, refining capacity, export controls, and existing contractual obligations all limited how fast physical metal could travel. The spread did not close smoothly. It widened under pressure. This created a feedback loop. Each attempt to close the gap consumed more available inventory, which pushed prices higher in both regions. The process fed on itself. The second mechanism was withdrawal of liquidity. In stable markets, sellers appear at predictable levels. They hedge, they rebalance, they provide depth. But when replacement cost becomes uncertain, selling becomes a liability. Institutions that normally sell futures to manage exposure began to step aside. They did not announce this decision. They simply stopped offering supply. When buyers met thin order books, price adjusted violently. This is how acceleration happens, not through excitement, but through absence. The third mechanism was forced participation. Some players do not have the luxury of waiting. Short sellers, industrial hedgers, and derivative counterparties operate under margin requirements. When price moves against them rapidly, decisions are removed from human hands. Systems liquidate positions automatically. Forced buying is the most aggressive form of demand because it is indifferent to price. It exists only to exit risk. As silver continued to rise, these forced participants added fuel. They were not expressing belief. They were surrendering exposure. This combination, arbitrage demand, seller withdrawal, and forced buying, created a market that no longer responded to traditional signals. Technical indicators became irrelevant. Historical resistance lost meaning. The market was no longer asking where price should go. It was asking where liquidity still existed. Meanwhile, a quieter but more consequential shift was happening in the physical layer. Dealers, refiners, and wholesalers began recalculating replacement cost hourly. In normal conditions, these actors operate on stable margins. They buy, they sell, they restock. During rapid repricing, that model breaks. If inventory is sold today and costs more tomorrow, profit turns into loss. The rational response is to widen spreads or pause sales entirely. This behavior does not show up immediately on price charts, but it reshapes reality on the ground. Premiums began rising even as spot prices climbed. Availability tightened. Delivery times extended. This divergence between screen price and street price confirmed that the acceleration was not speculative. It was structural. For business leaders, this moment reveals an uncomfortable truth. Markets can change character faster than organizations can update assumptions. Many procurement strategies are built on averages. Many risk models assume liquidity will always be present. When those assumptions fail, speed becomes a disadvantage. Companies exposed to silver, directly or indirectly, were forced to reassess. Not because price was high, but because price was unstable. Volatility signals uncertainty. Uncertainty disrupts planning. Some firms responded by securing inventory aggressively. Others delayed, hoping for retracement. The difference between these responses will define outcomes months later, not days. The acceleration also exposed a geographic shift in price authority. For decades, Western exchanges set the reference price, and the rest of the world adjusted. That hierarchy relied on confidence in paper markets and deep inventories. Shanghai challenged that hierarchy by anchoring price to immediate physical demand. Once that anchor held, other markets had limited options. They could deny it, lag it, or follow it. Denial carries risk. Lag creates arbitrage pressure. Following restores balance, but at a higher level. Acceleration is the system choosing the least damaging path. What makes this phase unique is not the speed, but the cause. This is not a reaction to a headline or a policy announcement. It is the consequence of years of underinvestment, rising industrial dependency, and over-reliance on paper abstraction. Silver did not suddenly become important. The market simply stopped pretending it was plentiful. Part 2 ends with an uncomfortable realization. When acceleration begins, for the reasons outlined here, it rarely ends quickly. It ends when supply and demand reach a new equilibrium, or when demand is destroyed. Neither outcome is immediate, and neither favors complacency. The story is no longer about whether prices will normalize. It is about what normalization now means. While screens flashed higher prices and analysts debated charts, a different response unfolded far from trading desks. It happened in factories, procurement offices, and supply chain meetings. This is where the silver story stopped being financial and became operational. The real economy does not have the luxury of interpretation. It deals in inputs and outputs. When silver prices accelerated, manufacturers did not ask whether the move was justified. They asked a simpler question: can we still get the metal when we need it? For many industries, silver is not optional. It is embedded into processes that cannot function without it. Solar panels require silver paste. Electronics rely on silver for conductivity. Medical equipment, defense systems, and advanced batteries all depend on silver's unique properties. There are substitutes on paper, but not at scale and not without redesign. This makes silver demand highly inelastic. When price rises sharply, demand does not fall. In many cases, it rises. The reason is straightforward. A factory would rather pay more for silver than shut down production entirely. Losing access to silver does not reduce profit margins. It eliminates revenue. As prices moved upward, procurement managers faced a difficult choice. They could delay purchases and hope for stabilization, or they could secure inventory immediately and absorb higher costs. For firms with long production cycles and strict delivery contracts, delay was not an option. They bought. This behavior amplified the pressure already building in the market. Unlike financial traders, industrial buyers do not trade in contracts. They take delivery. Each purchase removed physical metal from circulation. Each shipment tightened availability for the next buyer. What began as price acceleration became supply chain stress. At the same time, inventory strategies began to change. For years, companies optimized around efficiency. Just-in-time delivery reduced storage costs and freed capital. That model assumes stable supply and predictable pricing. Silver's move challenged both assumptions. As volatility increased, companies shifted from just-in-time to just-in-case. They increased order sizes. They extended inventory horizons. They accepted higher working capital costs in exchange for certainty. This transition is slow to reverse. Once a company decides it needs more buffer, it rarely reduces it quickly. The result is sustained demand that persists, even if prices pause. Meanwhile, the dealer and wholesaler layer experienced its own strain. These intermediaries exist to smooth markets. They hold inventory, manage logistics, and provide access. During rapid repricing, they face asymmetric risk. Selling inventory today creates exposure tomorrow if replacement costs rise faster than expected. To protect themselves, dealers adjusted behavior. Some widened premiums, others reduced available quantities, some temporarily withdrew listings altogether. These actions were not coordinated. They were rational responses to uncertainty. For end buyers, the effect was the same: higher real-world prices and reduced availability. This divergence between quoted prices and actual transaction prices revealed the depth of the issue. A market where metal cannot be sourced at screen prices is not liquid. It is constrained. Mining companies watch these developments closely. On paper, higher prices improved margins dramatically. Operating costs did not rise overnight. Revenue did. Yet, equity markets did not fully reflect this shift. Many mining stocks lagged the metal. Investors remained cautious, influenced by broader market volatility and geopolitical risk. This disconnect created a lag effect. The metal repriced first. The equities hesitated. Historically, the sequence is common. Physical markets react immediately to scarcity. Financial valuations adjust later, once cash flows become undeniable. Analysts update models. Institutions reallocate. The delay creates opportunity and risk in equal measure. For entrepreneurs and business leaders, Part 3 carries a broader lesson. Supply chains are not abstract systems. They are fragile networks built on trust, timing, and assumptions about availability. When a critical input becomes unstable, those assumptions collapse. Companies that anticipated disruption and secured supply gained resilience. Those that waited became exposed to volatility they could not control. The difference was not intelligence, it was preparedness. Silver's rise exposed how tightly modern industries are coupled to a small set of materials. It also revealed how quickly a financial signal can translate into operational pressure. The market was no longer debating value, it was confronting dependency. As inventories tightened and procurement intensified, the feedback loop strengthened. Higher prices signaled scarcity. Scarcity triggered buying. Buying removed supply. Reduced supply justified higher prices. This is how industrial panic forms, not through emotion, but through necessity. Part 3 ends with a reality check. Once the real economy adjusts its behavior, reversals become difficult. Factories do not unwind inventory strategies overnight. Supply chains do not regain elasticity quickly. The system had moved from awareness to action. And action, once taken at scale, reshapes markets far more forcefully than any headline ever could. By the time the market reached this stage, the conversation was no longer about silver alone. It was about what silver revealed. Part 4 is where the signal becomes a warning. Every economic system depends on reference prices. These prices guide contracts, risk models, capital allocation, and long-term planning. When reference prices lose credibility, uncertainty spreads far beyond the asset itself. That is what made the acceleration in silver strategically important. Silver did not just rise, it exposed a flaw. For decades, global markets operated under the assumption that paper instruments could efficiently represent physical reality. Futures markets were trusted to discover prices. Leverage was accepted as liquidity. As long as delivery was rarely demanded, the system held. But when physical demand reasserts itself, paper systems face a test they are not designed to pass. The Shanghai price crossing 87 marked a psychological threshold. It signaled that one major market had stopped negotiating with abstraction. It was pricing silver as it existed, not as it was promised. That distinction forced decision makers elsewhere to confront uncomfortable questions. If physical markets lead, what happens to hedging strategies built on paper? If replacement cost is volatile, how reliable are forward contracts? If liquidity vanishes under stress, how real is diversification? These are not theoretical concerns. They affect balance sheets. For banks, the environment became more complex. Providing liquidity in a market where price gaps persist carries risk. Each short position becomes harder to manage. Each derivative contract carries greater counterparty exposure. The incentive shifts from participation to preservation. This reduces market depth further. For governments and regulators, the move challenged long-standing assumptions about commodity security. Silver is no longer a minor input. It is embedded in energy transition plans, defense systems, and critical infrastructure. Price instability in such a material creates strategic vulnerability. Yet policy responses move slowly, markets move faster. For entrepreneurs and business leaders, the implications were immediate. Cost structures changed overnight. Forecasts based on historical ranges lost relevance. Strategic planning required new variables: availability, geopolitical risk, and inventory resilience. Some firms adapted quickly. They locked in supply, they renegotiated contracts, they accepted higher costs to protect continuity. Others hesitated, waiting for confirmation that the move was temporary. This hesitation carries risk because markets that reprice due to structural scarcity rarely revert quickly. Prices may consolidate, but the floor shifts upward. The old range becomes obsolete. This is the point of no return. Once a market accepts a higher price as necessary for balance, the burden of proof reverses. Instead of asking why prices are high, participants ask why they should be lower. Without a surge in supply or a collapse in demand, the answer is often unclear. Silver faces neither condition. Supply cannot expand rapidly. New mining projects take years. Recycling responds slowly to price. Demand, driven by industrial use and strategic stockpiling, remains firm. This asymmetry defines the next phase. Strategically, silver's move served as an early indicator of broader stress. Precious metals often act as pressure gauges. When they reprice sharply, they reflect deeper imbalances: currency risk, debt sustainability, geopolitical uncertainty. Silver amplified these signals because of its dual role. It is both a monetary asset and an industrial necessity. Stress in silver suggests stress in both finance and production. For decision makers, ignoring such a signal is costly. The lesson of Part 4 is not to predict prices. It is to recognize regime change. Markets do not announce transitions politely. They reveal them through behavior. When liquidity withdraws, when physical premiums rise, when regional price leadership shifts, the system is adjusting to new constraints. Those who adapt early focus less on price targets and more on exposure. They ask where they are vulnerable, where they are dependent, and where assumptions no longer hold. Those who delay often find themselves reacting rather than deciding. By the end of this phase, the silver market was no longer offering opportunity without risk. It was offering clarity, the clarity that scarcity has returned as a governing force, the clarity that efficiency has limits, the clarity that resilience carries a cost. Silver became a case study in how modern economies confront constraint. Part 4 concludes with a sober assessment. The acceleration was not an anomaly, it was a consequence, the result of years of structural pressure finally expressing itself through price. What comes next will not be smooth. Markets rarely transition quietly once foundational assumptions break. For those paying attention, the message was already clear. The system had crossed a threshold, and thresholds, once crossed, are rarely revisited.